Hey everyone, and welcome back to the Deep Dive.
You bet.
This program is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communications simple.
Absolutely.
iFindTaxPro.com is a platform for professionals and their clients and is open to everyone.
Right.
We encourage all our listeners to submit their tax and legal questions, as we may select yours for a future deep dive.
Sounds good.
Lenny Q,
Yep.
you submitted some really interesting questions about appraisals for charitable contributions.
I did.
So today we're diving into the IRS regulations surrounding those.
All right, let's get into it.
You're right, there's a lot more to it than simply being generous.
Yeah, you really have to make sure that your generous donations actually align with IRS rules.
Yeah.
Especially when you start dealing with larger amounts.
Okay, so let's break this down for Lenny.
Okay.
The materials you sent over were fascinating.
Good.
But what stuck out to me was how things change when the value of the donation goes over a certain limit.
Exactly.
So tell me a little bit about that.
Yeah, that magic number is $5,000.
Okay.
If you're donating property valued at $5,000 or more, the IRS wants to see a qualified appraisal.
Okay.
Think of it as a way for them to verify that everything's on the up and up.
So it's like the IRS saying, we love the generosity,
Yes.
but we also need to make sure everything is properly valued.
Right.
Especially with those larger donations.
Yeah.
Makes sense to me. But what exactly makes an appraisal qualified in the eyes of the IRS?
Well, a qualified appraisal needs to be prepared by someone with the knowledge and expertise to assess the specific type of property being donated.
Okay.
Not just anyone can do this, Lenny.
Right.
It has to be someone who really knows their stuff.
Got it.
This helps prevent overvaluation and keeps things fair for everyone involved.
So it's like a quality control measure to ensure accuracy and prevent any funny business.
Absolutely.
Are there specific forms or documents involved in this process?
Absolutely. When you're donating non-cash items, you'll need to fill out Form 8283.
Okay.
Non-cash charitable contributions. This form helps the IRS understand what was donated, how much it's worth,
Right.
and how you acquired it.
Okay.
They want all the details, Lenny.
They say every donation counts.
That's true.
Mine counted so much, even the IRS had to double check the math.
Uh-huh.
Okay.
Well, that's why documentation is so important.
Right.
The IRS might ask to see your appraisal during an audit,
Uh-huh.
so keeping those records organized is key.
All right, Lenny, we've got the basics down.
Okay.
Now, what happens if you miss the appraisal boat entirely? Is that an automatic no on the deduction?
Not necessarily.
Okay.
There's an exception called reasonable cause,
Okay.
which acknowledges that sometimes people might have a legitimate reason for not getting a qualified appraisal.
So there's some wiggle room for honest mistakes or unforeseen circumstances.
Absolutely.
But what exactly does reasonable cause look like in practice?
Right.
Do we have any examples of how the IRS actually applies this?
That's where it gets interesting.
Okay.
We've got a stack of real-life case studies here, Lenny.
Perfect.
Each one a little window into how the IRS has applied this exception in the past.
Okay.
These cases will show how the concept of substantial compliance played out.
Right.
Sometimes successfully, sometimes not.
Okay. This is where things get juicy. Case studies. I love it. Lenny, get ready, because we're about to see how these rules play out in the real world.
Let's do it.
Let's dive into the first case.
All right. Let's start with a case where things went right for the taxpayer.
Yep.
In this particular situation, the tax court actually allowed a deduction,
Wow.
even though the taxpayer had only provided an appraisal summary,
Interesting.
not a full qualified appraisal.
Yeah.
Why did they allow it?
I don't know.
Because that summary contained most of the required information, and the missing pieces were quickly provided during the audit.
So it sounds like the IRS was willing to cut the taxpayer some slack because they demonstrated a good faith effort to provide the necessary information, even if it wasn't perfectly executed right from the start.
Exactly.
That sounded about right.
It highlights that sometimes close enough can be good enough,
Yeah.
especially if you're cooperative and transparent with the IRS.
Okay, good to know.
However, as we'll see in our next case, things don't always go so smoothly.
Oh, that sounds like trouble brewing.
Yeah.
What happened in this next case?
Well, this time the tax court denied a deduction
Oh, no.
because the taxpayers failed to obtain any appraisal for their donated stock,
Really?
and it gets worse.
Oh, no.
They also didn't even provide the IRS with basic information about the stock itself.
Oh, wow. So they basically provided zero documentation to back up their claim. That doesn't sound like a good strategy.
No, it does not.
What was the court's rationale for denying the deduction?
The court emphasized that the purpose of these appraisal requirements is to give the IRS enough information to properly assess the claimed value of the donation
Okay.
and to spot potential issues.
Makes sense.
Without an appraisal or basic information about the donated property, the IRS was basically left in the dark.
So it's not just about having an appraisal. It's about having an appraisal that provides enough detail for the IRS to do their job.
Exactly.
What's next on our list?
Next up, we've got a case where the taxpayer made a mistake on Form 8283,
Oh.
but was still able to secure the deduction.
Really?
They had some missing information on the form,
Okay.
but they had attached a complete appraisal report to their tax return.
Interesting. So it seems like attaching that detailed report acted as a sort of safety net, even though there were errors on the form itself.
Yes.
Does the IRS often overlook these kinds of mistakes if a thorough appraisal is included?
In this case, the court saw it as substantial compliance.
Yeah.
The taxpayer clearly intended to follow the rules
Uh-huh.
and had taken the time to get a proper appraisal,
Right.
even if they messed up the form a bit.
So a bit of a win for common sense and good intentions.
Yes.
Let's move.
Later.
Okay.
The taxpayer submitted their appraisal report late and missed the contribution date. But the IRS still allowed the deduction.
Hey, Rob.
How is that possible?
I don't know.
Well, the IRS already had all the necessary information?
So even though the timing was off, they were able to demonstrate that they weren't trying to pull a fast one.
Exactly.
Does the IRS ever penalize taxpayers for late submissions, even if they ultimately have all the required documentation?
It definitely happens.
Okay.
But this case highlights the IRS isn't always looking for reasons to deny deductions.
That's good.
If they see a genuine effort to comply, they can be surprisingly reasonable.
Well, that's good to know. Let's hope that trend continues in our next case.
Okay.
What happened there?
Unfortunately, the tax court wasn't so forgiving this time.
Oh, no.
They denied deductions for 2 separate donations,
Okay.
a wall partition and a car.
What?
Why?
I don't know.
The taxpayers hadn't included properly filled out Forms 8283,
Right.
and just as important, hadn't obtained qualified appraisals for either donation.
Wow.
They tried to make up for it by providing letters from appraisers during the audit.
But it was too little too late.
So a lesson for all of us. You can't just play catch-up with the IRS.
Right.
You've got to have your ducks in a row from the very beginning.
Exactly.
Proactive planning is key when it comes to charitable donations and taxes.
Absolutely.
Now, this next case gets a bit more complex.
Okay.
It deals with the intricacies of donating partnership interests.
Gotcha.
The taxpayers in this case tried to claim a deduction for their donation,
Okay.
but the IRS wasn't having it.
Oh, no.
What went wrong with the donation of the partnership interests?
Well, there were several major issues with the appraisals they submitted.
Okay.
First, the appraisals were done by a CPA who had no proven experience valuing these types of partnership interests.
So they weren't really qualified to do it.
Right. They weren't qualified.
Okay.
Second, they didn't actually get appraisals for the specific partnership interests themselves,
Oh.
but rather for the stock that the partnerships held.
Okay, so it sounds like they tried to take a shortcut and ended up with a tangled mess of compliance issues. Exactly.
Is it common for people to misunderstand what needs to be appraised?
It happens more often than you might think.
Really?
This case serves as a reminder that when you're dealing with unique assets like partnership interests, you absolutely need an expert who understands the specific nuances of valuation in that area.
Got it.
Otherwise, you're setting yourself up for trouble.
Accuracy and expertise really are paramount here.
Yes, they are.
Okay, what's next?
All right, moving right along. In this next case, we have another denied deduction,
Okay.
this time for a donation of stock.
Of stock.
Oh, reason.
What was it?
The appraiser had valued the buildings owned by the corporation
Wow.
instead of the stock itself.
Wow.
Big mistake.
Talk about missing the mark. This really drives home the importance of choosing the right appraiser.
Yes,
You need someone who understands exactly what needs to be valued.
exactly.
Were there any other interesting details in this case?
What's interesting here is that the court considered this a fatal flaw. Even the taxpayer's argument of substantial compliance couldn't save them.
Okay.
The regulations are crystal clear. You need a qualified appraisal of the specific property that was donated.
So valuing something related to the donated property simply doesn't cut it.
It does not.
Precision is key.
It is.
Okay, what's next on our list?
Next, we have another unfortunate situation where deductions were denied.
Ah.
This time for a donation of medical equipment.
Medical equipment, okay.
The taxpayers had attached several forms 8283 to their returns,
Okay.
but many were missing accompanying appraisal reports and receipts.
So missing documentation again? Did they attempt to fix this during the audit?
They did try to have appraisers prepare those missing reports during the audit,
Okay.
but the court wasn't swayed.
Really?
Remember, in a previous case, the court allowed this.
Yes.
Well, in that case, the reports had been prepared at the time of donation,
Oh.
but simply weren't attached to the return.
Okay.
In this case, they were created after the fact, which made all the difference.
Wow, so timing really does seem to be everything. Is there anything else noteworthy about this case?
There is. The taxpayers argued that they had reasonable cause for some of the missing information because a fire had destroyed their records.
Oh, that's terrible. Did the court accept that explanation?
Unfortunately, no.
Really?
They said that an accidental loss of records doesn't automatically qualify as reasonable cause.
Ouch. So while it's a valid reason, the court still holds taxpayers responsible for maintaining those important documents.
Yes.
Lenny, I know record keeping can be a pain,
Right.
but this really highlights the importance of backing up your records.
Yes.
It's better to be safe than sorry.
Absolutely.
Okay, for our final case study, we have a situation that underscores the importance of dotting your I's and crossing your T's when it comes to appraisal documentation.
Yeah, definitely.
Okay, Lenny, let's hear it. What happened in this last case?
In this case, the taxpayer's Form 8283 was riddled with omissions,
Really?
particularly in the appraiser declaration section. They left out crucial details and simply wrote, "See attached appraisal."
Come on. Are you serious? That's almost comical.
Yeah.
They're basically telling the IRS to do the work for them.
Right.
And to make matters worse, the appraisal they attached was nothing more than a letter signed by an attorney who claimed to be familiar with the property, in this case, a gravel pit.
Right, and this attorney wasn't even a licensed real estate appraiser.
Oh, wow. So they
Yeah.
really just winged it.
They did.
And get this.
Okay.
The letter lacked essential details like the valuation method used,
Right.
the basis for determining fair market value,
Right.
the property's condition,
Yeah.
and a statement that it was prepared for tax purposes.
Yeah, they really just kind of handed over this document that was barely an appraisal and provided none of the specific information IRS expects.
What was the court's reaction?
Unsurprisingly, the tax court didn't buy it.
Okay.
They found that the taxpayer hadn't even come close to substantial compliance.
Oh.
In fact, they used the word slipshod to describe their effort.
Yeah. Ouch. Well, that's a harsh but important lesson, Lenny.
Yes.
This last case really drives home the importance of being meticulous and thorough when it comes to charitable contribution appraisals.
It really does.
The IRS isn't messing around, and if you try to cut corners or submit incomplete documentation, it could come back to bite you.
I couldn't agree more.
These case studies really illustrate that adhering to IRS requirements
Yes.
and seeking guidance from a qualified tax professional are crucial when navigating charitable contributions.
Exactly.
Now, you mentioned that you're particularly interested in a recent case,
Yes.
the Hohenscheid case,
Yes.
which deals with some similar issues.
That's right.
That's right. This case involves a donor who tried to donate stock to Fidelity Charitable right before selling it.
Yep.
I'm curious to hear how this played out.
Well, it's a fascinating case that really highlights the potential pitfalls of last-minute donations.
All right, Lenny, we're about to dive into the details of the Hohenscheid case.
Sounds good.
This one's a real nail-biter, so get ready for some more tax court drama.
Okay. All right, let's unpack the Hohenscheid case.
Huh?
It was decided just this year in 2023.
Wow, recent.
And it really illustrates the complexities you can face when donating appreciated assets,
Right.
especially when you're donating right before selling them.
Ooh, last-minute donations and potential tax maneuvers. Sounds like a recipe for IRS scrutiny.
Certainly is.
Lenny, pay close attention, especially if you're considering any significant charitable contributions in the near future.
Yes, good advice.
So tell me what exactly happened in this case.
So we have Mr. Hohenscheid.
Yep.
Let's call him Scott.
Okay, Scott.
Who decided to donate shares of stock in his company to Fidelity Charitable.
Okay.
As we discussed earlier, Fidelity Charitable manages donor-advised funds.
Right.
It's a pretty common way to make charitable donations.
Okay, seems straightforward enough so far.
Right.
What's the catch?
Well, Scott made this donation just 2 days before selling those same shares to a third party.
Oh.
This, of course, made the IRS raise an eyebrow.
Yeah, I bet.
They questioned the timing and wondered if Scott was trying to avoid paying capital gains taxes on the sale.
Ah, I see where this is going. A classic case of potential tax avoidance.
It could be.
Did Scott think he could actually get away with this?
Well, the IRS certainly thought he was trying to pull a fast one.
Okay.
They argued that Scott engaged in something called an anticipatory assignment of income.
Okay.
Essentially, they claimed that because the sale was already in motion and practically certain to happen when he donated the shares,
Yep.
he should be taxed on the capital gains as if he had sold them directly.
That makes sense.
Right.
It seems like he was trying to get a tax deduction for the charitable contribution
Right.
while also avoiding paying taxes on the profit from the sale.
Exactly.
So what did the court have to say about all this?
Well, the court had to answer a few key questions.
Okay.
First, they needed to figure out the exact date of the gift to determine when Scott actually gave up control of the shares. Second, they had to decide if this donation qualified as an anticipatory assignment of income, as the IRS argued.
Right.
And finally, they had to see if Scott met those qualified appraisal requirements we talked about earlier.
Wow, so many moving parts.
Yeah.
This case really hinges on some very specific details and legal interpretations.
It does.
What did they ultimately decide?
So the court's findings are interesting.
Okay.
They ultimately said that Scott's donation was a valid gift.
Okay.
This means he genuinely relinquished control of the shares.
Okay, so it was a gift.
It was a gift. However,
Okay.
they also determined that the gift wasn't effective until the stock certificate was delivered,
Oh.
which was very close to the sale date.
So even though Scott intended to make a charitable donation, the timing of the actual transfer really mattered to the court.
Yes, it did.
It seems like the court was looking at the substance of the transaction rather than just the form it took.
You got it. And here's where it gets even more interesting. The court said Scott was still responsible for the capital gains tax on the sale,
What?
even though the gift was legitimate.
Wait, how is that possible? Didn't he give the stock away?
Well, the court reasoned that the sale was too far along by the time the gift was complete. They basically said that the donation wouldn't have happened without the impending sale.
Okay.
It seemed pretty clear that Scott was using the donation to avoid paying taxes.
So the court saw right through his plan.
They did.
It seems like they're saying you can't just use charitable donations as a shield to get out of paying taxes you legitimately owe.
Exactly. Substance over form, remember.
Yes.
The donation looked like a gift,
Right.
but the reality was that it was all tied up with the sale.
Yeah.
Scott was trying to get a tax benefit he wasn't entitled to.
Okay, so we've established that the gift was valid.
Yes.
But Scott was still liable for the capital gains tax.
Correct.
What about the charitable contribution deduction? Was he allowed to claim that?
Well, not so fast.
What?
Remember the qualified appraisal requirement.
Yes.
Even though the court found this was an assignment of income,
Right.
that alone didn't disqualify Scott from taking a charitable deduction.
Okay.
However, they ended up denying the deduction because Scott didn't meet the IRS requirements for a qualified appraisal.
Oh, no. It seems like Scott's attempt to outsmart the IRS completely backfired.
It did.
What exactly was wrong with the appraisal?
There were multiple problems.
Oh, no.
First, the appraisal didn't adequately describe the appraiser's qualifications and experience in valuing this specific type of stock.
So the person wasn't qualified.
Right. It's not enough to just get any appraiser.
Right.
They need to have the right expertise.
Makes sense.
On top of that, the appraisal listed an incorrect contribution date.
Oh, really?
As we've seen in the previous cases, getting those dates right is crucial.
It is.
And there were even more issues that undermine the appraisal's credibility.
So Scott basically messed up every step of the appraisal process.
He did.
He really seems to have dropped the ball here.
He definitely did, and to make matters worse,
What else?
he tried to claim reasonable cause for these issues, arguing he relied on a financial services manager to conduct the appraisal,
Okay.
even though he knew this person wasn't really qualified.
Come on, Scott. Seriously. He knowingly chose someone unqualified and then tried to use that as an excuse. That's not a good look.
The court wasn't buying it either.
Oh.
They said choosing an unqualified appraiser didn't demonstrate the ordinary business care and prudence you need to establish reasonable cause.
Oh, wow.
He had every opportunity to hire a qualified professional, but decided to cut corners. And it ended up costing him.
Wow, Lenny, what a story.
I know, right?
This case really drives home the point that when it comes to charitable contributions,
Yeah,
especially those with potential tax implications,
absolutely.
you absolutely have to be meticulous and follow the rules.
You do.
Trying to outsmart the IRS is risky business.
It is.
Couldn't said it better myself.
This case shows just how complicated things can get with last-minute donations, especially when you're dealing with unique assets like stock.
Yeah.
And it highlights the importance of doing things by the book and making sure you're meeting all the IRS requirements.
So, Lenny, after all these wild cases,
Yeah.
what are the key takeaways you should be thinking about regarding charitable giving and appraisals?
Well, first and foremost, never forget that when you're donating property worth over $5,000, a qualified appraisal is absolutely essential.
Okay.
It's not just a good idea, it's an IRS requirement.
Right.
And failing to get one could mean you lose your deduction.
Don't try to wing it or rely on a friend who dabbles in real estate.
Right.
Get a professional who specializes in appraisals for the specific type of property you're donating.
Exactly.
It's worth every penny.
It's like insurance for your charitable deduction.
Yes.
Better safe than sorry, especially if you want to avoid problems with the IRS down the road.
And if you're ever unsure about anything, talk to a qualified tax professional.
Absolutely.
They can help you understand those tricky IRS regulations. Make sure you're meeting all the requirements.
Yeah.
And help you maximize your tax benefit
Absolutely.
while staying on the right side of the law.
Exactly.
Remember, Lenny, generosity is fantastic,
Yes.
but informed generosity is even better.
Absolutely.
The IRS wants to encourage giving,
Yes.
but they also want to ensure everyone plays by the rules.
Right.
Okay, Lenny, before we wrap things up, I want to leave you with one final thought.
Okay.
Given everything we've talked about today, what strategies can individuals and businesses use to make sure their charitable giving aligns with IRS guidelines while also getting the most out of their tax benefits?
That's a fantastic question, Lenny, and one that deserves a conversation with a knowledgeable tax advisor.
Okay.
It's all about planning ahead, understanding the ins and outs of the regulations, and seeking professional advice when you need it.
Okay.
Don't let uncertainty or the complexity of these rules keep you from giving generously.
Right.
Approach it strategically,
Okay.
and you'll be able to give freely while making sure your tax planning is solid.
And remember, Lenny, you can always connect with a qualified tax professional through iFindTaxPro.com, today's sponsor.
Great resource.
They make tax and legal compliance clear and easy so you can focus on what matters most,
Right.
your generosity.
That's right.
Don't forget to send us your questions for future deep dives.
Yes, please do.
Until next time.
So, Lenny, we've walked through a ton of info today.
We have.
From the general appraisal rules
Right on.
to those real-world cases, and even that nail-biting Honscheid case.
That was a good one.
What are the biggest things you should take away?
Yeah, what should I be thinking about?
When it comes to charitable giving and the IRS?
Well, for me, the most important thing is knowing that if you're donating property worth over $5,000,
Yeah.
a qualified appraisal isn't optional.
No.
It's a must.
It is.
Skip it.
Yeah.
And you could lose that deduction entirely.
You could.
It's that simple.
Couldn't agree more.
And don't try to DIY this or rely on someone who's just sort of familiar with valuations. Get a true professional who specializes in appraisals for the exact kind of property you're donating.
Absolutely.
Seriously, Lenny, think of it like this.
Okay.
If you were donating a rare antique,
Uh-huh.
you wouldn't ask your buddy who likes flea markets to
No.
assess its value, right?
Right. No, you wouldn't.
Same logic applies here.
Perfect analogy.
It's an investment
It is.
to protect your deduction
Yes.
and, frankly, your peace of mind when it comes to the IRS.
Absolutely.
And this has been a recurring theme today,
It has.
but it bears repeating.
Okay.
When in doubt, talk to a tax pro.
Yes. Good advice.
They can help you navigate the IRS maze,
Right.
make sure you're ticking all the boxes,
Yeah.
and ultimately help you give generously without running into any tax headaches.
Couldn't have said it better myself.
They can make sure your heart and your head are both in the right place when it comes to charitable giving.
Absolutely. Remember, Lenny, the IRS wants people to be generous,
Right.
but they also need to make sure the system is fair. And everyone's playing by the rules.
Okay, Lenny, we've covered a lot of ground today.
We have.
But before we sign off, I want to leave you with one final thought.
Okay, shoot.
Given the complexity of all these cases and rules, what are some strategies people can use to make sure their charitable giving aligns with what the IRS wants while still getting the most out of those tax benefits?
That's a great question to ponder, Lenny, and honestly one that warrants a good chat with a savvy tax advisor.
Yeah.
They can tailor advice to your specific situation,
Right.
but in general, it boils down to this.
Okay.
Plan ahead.
Uh-huh.
Don't wait till the last minute.
Makes sense.
Really understand the nuances of the regulations.
Okay.
And don't be afraid to ask questions.
Yeah, ask questions.
Don't let fear of complexity keep you from giving.
Okay.
With a bit of strategy and the right guidance, you can be both generous and smart about your taxes.
And remember, Lenny, you can always connect with a qualified tax professional through iFindTaxPro.com, our sponsor for today's deep dive.
Great resource.
They're all about making tax and legal compliance clear and simple. so you can focus on what matters,
Right.
your generosity.
That's it.
Don't forget to send us your questions for future episodes.
Yes, please do.
Until next time.